The Industrial Revolution did not begin with factories. It began with finance. Long before smokestacks rose over Manchester or locomotives cut through the countryside, a quieter transformation had already taken place, one that changed how capital was raised, risk was shared, and time itself was priced. The machines would capture the eye, but it was money organized in new ways that gave them life. Without the financial revolution that preceded it, the industrial one would have remained a collection of clever inventions rather than a civilization-altering force. Before industry economies were constrained by organic limits, production depended on muscle windwater and seasons. Capital accumulated slowly. Wealth was land-bound and inheritance-driven. Finance existed, but it was narrow, focused on trade war and state debt. Investment horizons were short. Risk was personal. Failure was often fatal. What the Industrial Revolution changed was not merely how goods were made, but how uncertainty could be absorbed at scale. Britain, the cradle of industrialization, had already built a uniquely modern financial ecosystem. The aftermath of the Glorious Revolution left the country with something rare in history: credible public finance. The Bank of England, a functioning bond market, enforceable contracts, and relatively predictable rule of law, created conditions where capital could be mobilized beyond family networks. This mattered enormously. Industrial projects required large upfront investment with uncertain payoffs. No single craftsman or merchant could fund a canal, a mill, or a railway alone. Finance had to evolve to match ambition. The joint stock company became the critical bridge between invention and industry. By allowing capital to be pooled and risk to be shared, it transformed isolated innovation into systemic transformation. Investors could lose money without losing freedom. Failure no longer meant ruin, it meant bankruptcy. This subtle shift changed behavior profoundly. Risk-taking increased not because people became reckless, but because failure became survivable. The Industrial Revolution is unimaginable without this financial innovation. Banks, too, changed character. No longer mere custodians of deposits or financiers of trade, they became intermediaries of industrial capital. They evaluated projects, extended credit, and connected savers to entrepreneurs. Credit expanded not as an act of charity, but as a calculation. Interest rates became signals of opportunity and danger. Capital flowed toward factories, mines, and infrastructure, toward fixed assets that promised productivity rather than immediate liquidity. Nowhere was the financial impact more visible than in infrastructure. Canals, turnpikes, and later railways required unprecedented sums. These projects did not merely move goods, they restructured space and time. Markets expanded, prices converged, regional economies integrated, but they also introduced new financial dynamics. Long-term bonds funded projects whose returns would be realized decades later. This forced societies to think in longer horizons. Finance stretched time, allowing future productivity to justify present sacrifice. With expansion came volatility. The Industrial Revolution did not produce steady growth, it produced cycles. Booms followed innovation. Busts followed excess. Credit expanded too far, then contracted violently. The canal mania of the late 18th century and the railway manias of the 19th were not anomalies, they were features. Finance, in amplifying opportunity, also amplified error. Speculation thrived alongside genuine investment. Fortunes were made and lost with dizzying speed. These cycles reshaped financial consciousness. Risk became systemic rather than individual. A failed harvest once starved a region. A failed bank could now freeze an economy. Crises like the Panic of 1825 revealed how interconnected finance and industry had become. Factories closed, not because demand vanished, but because credit did. Liquidity, once an abstract concept, became a matter of survival. The social consequences were profound. Industrial finance redistributed wealth faster than any previous system. Capital owners accumulated power. Workers sold labor rather than produce. Wages replaced subsistence. This monetization of life deepened markets, but also insecurity. Financial shocks translated directly into unemployment and hardship. The invisible hand that Adam Smith described now operated at industrial scale, with consequences far beyond the imagination of the 18th century. Governments could not remain spectators. The Industrial Revolution forced the state to redefine its financial role. Regulation emerged not from ideology, but from necessity. Banking crises demanded intervention. Infrastructure required guarantees. Social unrest forced fiscal response. The modern relationship between state finance and industry was forged not in theory, but in repeated confrontation with instability. And yet, despite turmoil, the financial impact of industrialization was overwhelmingly transformative. Productivity exploded. Living standards over time rose. Capital markets deepened. Financial literacy spread. The idea that money could be invested, not merely saved or hoarded, became cultural. Time itself was financialized. Futures were discounted. Growth became expected rather than exceptional. What makes the Industrial Revolution unique in financial history is not that it created new instruments, but that it normalized a new mindset. Capital became restless. Money demanded return. Innovation required funding. And society accepted volatility as the price of progress. This was a psychological shift as much as an economic one. The future became something to invest in rather than fear. Standing amid the factories of the 19th century, one could already see the outlines of the modern financial world. Leverage cycles, inequality, innovation, crisis, recovery. The Industrial Revolution did not solve humanity's economic problems. It scaled them. It multiplied both opportunity and fragility. And in doing so, it forced finance to become more sophisticated, more institutional, and more powerful than ever before. As smoke darkened skies and machines multiplied output, money learned to move faster, think longer, and take greater risks. Finance ceased to be a servant of trade alone and became the engine of transformation itself. The consequences of this shift would echo through centuries, shaping empires, crises, and ideologies, raising questions not only about how wealth is created, but about who controls the mechanisms that create it. Questions that would only grow sharper as industrial capitalism matured and societies began to reckon with the financial forces they had unleashed. Forces that promised progress, but demanded discipline. Forces whose benefits were undeniable, but whose costs were unevenly distributed forces that would soon provoke new institutions, new conflicts, and new ideas about money, labor, and power. A reckoning that would continue as the Industrial Revolution moved from its explosive beginnings into a more complex and contested phase, a phase in which finance would no longer merely fund industry, but shape its direction, its limits, and its consequences in ways that few could fully anticipate at the time. A phase whose full implications would reveal themselves not only in balance sheets and stock prices, but in the structure of modern society itself. For as the Industrial Revolution matured, finance ceased to be merely a facilitator of growth and became a force that reshaped labor politics and the distribution of power. By the mid-19th century, industrial finance had created a new economic rhythm. Growth was no longer seasonal or episodic. It was expected to be continuous. Capital demanded expansion. Investors expected returns. Firms reinvested profits to stay competitive. This feedback loop locked economies into a growth imperative that had never existed before. Stagnation was no longer normal, it was failure. And finance became the mechanism through which that judgment was enforced. With this shift came new institutions. Stock exchanges expanded from elite clubs into central organs of economic life. Accounting standards evolved to measure profitability over time. Insurance markets grew to buffer catastrophe. Central banks refined their roles as lenders of last resort. Each institution arose not from abstract design, but from repeated crises that exposed what industrial finance could not survive without. Stability was engineered through experience, yet stability was never evenly distributed. Industrial finance concentrated ownership while dispersing labor. Shareholders captured upside, workers absorbed volatility. When credit tightened, factories closed, and wages fell long before dividends were cut. This asymmetry fueled political movements, labor unions, socialist parties, regulatory reform. Finance, once an invisible infrastructure, became a visible source of grievance. The Industrial Revolution forced societies to confront the social cost of financial cycles. Governments responded incrementally. Bankruptcy laws softened. Labor protections emerged. Public education expanded to create an industrial workforce capable of operating complex machinery. Fiscal policy evolved as states began to smooth downturns rather than merely endure them. These responses did not eliminate volatility, but they acknowledged that industrial finance had consequences beyond investors. Internationally, industrial finance reconfigured power. Nations with deep capital markets industrialized faster and projected influence abroad. Those without became dependent. Capital flowed across borders, financing railways, mines, and plantations, often entangling economic development with imperial domination. Finance did not merely follow empire, it financed it. The Industrial Revolution globalized inequality as well as production, and yet for all its disruption, the financial legacy of industrialization was not purely extractive. Over time, productivity gains raised living standards. Credit enabled entrepreneurship beyond aristocratic circles. Innovation accelerated. The modern middle class emerged financed by wages, savings, and access to credit. Industrial finance created both the extremes of wealth and the possibility of broad prosperity. This duality is the enduring lesson. The Industrial Revolution did not simply introduce machines. It introduced leverage, financial, social, and political. Leverage magnified human intention. Where institutions were strong, it amplified progress. Where they were weak, it amplified exploitation and crisis. Finance became the lens through which societies experienced industrialization's benefits and pains. Looking back, the Industrial Revolution's greatest financial impact was not any single innovation, but the normalization of systemic risk. Economies accepted that progress would arrive unevenly punctuated by booms and busts. The challenge became not how to avoid cycles, but how to survive them. Modern economic policy, from central banking to welfare states, is a direct response to this realization. The final lesson of the Industrial Revolution is therefore not about machines or money, but about scale. Finance allowed human ambition to scale beyond biological and geographic limits. In doing so, it forced societies to build institutions capable of managing forces far larger than any individual. Those institutions are still evolving, still contested, and still shaped by the same tension first revealed in the 19th century: how to harness financial power without being consumed by it. If this journey through the financial impact of the Industrial Revolution reshaped how you view growth capital or modern markets, share what stayed with you. And if you want to continue exploring how the past forged the financial systems we live inside today, follow the channel and stay with this unfolding story, because the smoke of the first factories has long cleared. but the financial forces they unleashed continue to shape our world in ways we are still struggling to understand.